Some of the biggest shifts in Social Security don't arrive with dramatic headlines or sudden shocks. They slip in quietly, wrapped in small percentage changes and technical adjustments, and only reveal their impact months later when people realize their budget feels tighter than expected. That's exactly the kind of moment we're heading into with the changes coming in 2026. Welcome back to U.S. Pension Insight. I'm Michael Harris. Today we're taking a careful, clear look at what's changing with Social Security in 2026, what isn't changing, and why many people may feel very little relief even though benefits are technically going up. This isn't about fear or exaggeration. It's about understanding the full picture so you can plan instead of being caught off guard. And before we go any further, make sure to hit like, share this with someone who relies on Social Security, and subscribe to U.S. Pension Insight so you stay informed as these changes roll out. Let's start with something that surprised even people who follow Social Security closely. Beginning in January 2026, the average retirement benefit is increasing. On paper, that sounds like good news, and in a sense, it is. Any increase matters when you're living on a fixed income, but here's the disconnect many retirees are already anticipating. Even though the check is going up, the money you actually feel you have available each month may barely change at all. That's because other expenses, especially healthcare and housing, are rising at the same time, and in some cases faster. The adjustment everyone hears about first is the cost of living increase, commonly called the COLA. For 2026, benefits are rising by 2.8%. This applies across the board to retirement benefits, disability payments, and supplemental security income. That percentage is fairly close to the historical average and slightly higher than the previous year. For someone receiving the average retirement benefit, it translates to roughly $50 to $60 more per month. Now, that amount isn't meaningless. For many households, that covers part of a grocery run, a prescription refill, or a utility bill. But the frustration sets in when people realize that this increase is based on an inflation formula that doesn't fully reflect how older Americans actually spend their money. Social Security uses an index that tracks the spending habits of working-age households. Retirees, on the other hand, tend to spend a much larger share of their income on medical care, insurance, and housing. Those categories have been rising faster than general inflation. That's why so many people describe Social Security increases as feeling like a raise on paper, but not in real life. You see the higher number on your benefit letter, but your bank account doesn't feel much different by the end of the month. And that feeling becomes even stronger once Medicare enters the conversation. For 2026, Medicare Part B premiums are seeing a noticeable jump. The standard monthly premium is increasing significantly, along with the annual deductible. When Medicare premiums rise, they're usually deducted directly from Social Security checks. That means a portion of your COLA never actually reaches you. If your benefit goes up by around $50, but your Medicare premium rises by close to $20, your real increase is much smaller before you even account for rent, food, or insurance. For higher income retirees, the situation can be more severe because of income-related premium adjustments. These additional charges can push monthly Part B premiums into the hundreds of dollars. And yes, those amounts are also taken straight out of Social Security. For people affected by these adjustments, the COLA may not come close to covering the increase in healthcare costs. This is where a lot of confusion circulates online, particularly around something called the hold harmless rule. Here's what that rule actually does. For most beneficiaries, Medicare is not allowed to raise Part B premiums in a way that causes your Social Security check to be lower than it was the previous year. If the premium increase is larger than your COLA, the adjustment is limited so your net benefit doesn't shrink. This protection applies automatically. You do not need to call Social Security to request it, and you do not lose it if you fail to act quickly. Unfortunately, misinformation spreads fast. People see urgent posts claiming they must call immediately or risk losing money. That's almost never how Social Security operates. Real changes are communicated by official letters, not viral videos. Those unnecessary calls clog phone lines and make it harder for people with genuine emergencies like survivors or disability applicants to get through. Taxes are another area where 2026 brings changes that are easy to misunderstand. A new federal tax deduction is now available for seniors aged 65 and older. This additional deduction can reduce taxable income by several $1,000s, depending on whether you file individually or jointly. It begins to phase out at higher income levels and does not make Social Security benefits completely tax-free. That point is critical because many people assume this change eliminates taxes on benefits altogether, which it does not. For middle-income retirees, however, the deduction can make a meaningful difference. It may lower overall tax liability and free up some cash flow. For lower-income seniors who already owe little or no federal income tax, the impact may be minimal. It's also important to note that this deduction is temporary unless Congress extends it, which means it should be factored into short-term planning rather than assumed as a permanent change. If you're still working while receiving Social Security, the earnings rules are another area to pay close attention to. For those who claim benefits before reaching full retirement age, there is a limit on how much you can earn before benefits are temporarily withheld. In 2026, that earnings threshold is increasing, allowing people to earn more without triggering reductions. This adjustment gives working retirees a bit more flexibility, especially in an economy where many people are extending their careers out of necessity. What often gets overlooked is how these withholdings work over time. When benefits are reduced because of earnings, that money isn't gone forever. Once you reach full retirement age, Social Security recalculates your benefit to account for the months that were withheld. That results in a higher monthly payment going forward. It doesn't help if you need the money immediately, but it's not a permanent penalty. For people receiving Social Security disability insurance, the rules around work are changing as well. The income limit that determines whether someone is considered able to engage in substantial work is increasing. This matters enormously for individuals who are trying to balance limited work with maintaining benefits. Exceeding that threshold can result in losing eligibility, while staying just under it can provide much-needed income stability. The system does offer work incentive programs, but they are complex and often poorly explained, leaving many people uncertain and anxious about making the wrong move. SSI recipients will also see a modest increase in their monthly payments. Even with the adjustment, the maximum benefit remains very low, especially when compared to the cost of housing and healthcare. Compounding the problem are resource limits that haven't been meaningfully updated in decades. These outdated thresholds mean that saving even a small amount of money can jeopardize eligibility. Because SSI is frequently tied to Medicaid, a minor increase in income can trigger the loss of health coverage, creating a situation where someone is technically earning more but financially worse off. Survivor benefits are another area where lack of information causes real harm. Many widows and widowers are never told they can claim benefits earlier than full retirement age. Survivor benefits can begin as early as age 60, or even earlier for disabled survivors. If someone delays without realizing their eligibility, they generally cannot recover payments for all the missed months. Too often, people assume the one-time death benefit is the only assistance available, when in reality, ongoing benefits may exist. Misinformation has become one of the biggest challenges surrounding Social Security. Scam videos and fake alerts mimic official language and create panic. They urge immediate action, claiming benefits are at risk. In reality, Social Security rarely operates with sudden deadlines. When something requires attention, you receive official notice by mail or through a verified account. Staying calm and skeptical is one of the best defenses against being misled. All of this unfolds against the backdrop of long-term concerns about the Social Security Trust Fund. Projections show financial strain in the coming decade if lawmakers fail to act. That reality creates ongoing anxiety, even though no structural changes are taking effect in 2026. Despite the pressure, it's worth remembering that Social Security has never missed a payment. It has continued through wars, recessions, political standoffs, and public health crises. The system is strained, but it is not collapsing next year. So what does all of this mean for you in practical terms? It means your benefit is likely increasing modestly, while healthcare costs are also rising. It means working retirees have slightly more flexibility, and some seniors may see tax relief depending on their income. It also means that confusion and misinformation remain serious risks. The most important thing you can do is stay informed without panic. Read your notices carefully. Question urgent claims online. Ask for clarification when something doesn't make sense. And share your experiences, because many people learn best from others navigating the same system. If this breakdown was helpful, subscribe to U.S. Pension Insight and share it with someone who might need clarity right now. And leave a comment below. What part of Social Security feels the most confusing or stressful to you as we head into 2026? I read those comments and we'll keep working through this together.